Good evening, everyone, and welcome to today's Market Close Report. Let's start with a quick snapshot of the major global markets. In the US, the Nasdaq Composite closed sharply higher at 25,929 points, up 0.86%. The S&P 500 edged up 0.3% to 7,405 points. However, the Dow Jones Industrial Average slipped 0.16%, finishing at 50,786 points. Market fear levels dropped significantly, with the VIX index falling more than 12% to close at 18.92. In the bond market, the 10-year Treasury yield rose to 4.55%, up 0.35%. The US dollar index was nearly flat at 100.00. The offshore Chinese yuan held steady at 6.78 against the dollar. In commodities, oil prices saw a notable decline, with WTI crude falling 3.48% to $91.32 a barrel. Safe haven gold, on the other hand, gained 0.94% to close at $4,349. Bitcoin edged higher to around $63,440. The defining characteristic of today's market was extreme divergence. Capital did not flow broadly into all assets. Instead, it moved out of defensive assets, the A-share market, and commodities, and concentrated into two main directions. The first direction was the Nasdaq growth stocks, led by artificial intelligence and megacap tech names. The QQQ ETF rose 1.56%, Nvidia gained 1.73%, and Tesla surged 4.59%. The second direction was pure safe haven assets like gold. This suggests that money is making a dual bet. On one hand, it is betting on the earnings certainty of tech leaders. On the other hand, it is hedging against macro uncertainty. So how did global markets move today? During the Asian session, the A-share market sold off heavily. The Chi-Next index dropped 3.69%, and the Shenzhen Component Index fell 3.22%. Sentiment was extremely pessimistic. During the European session, oil prices tumbled, and commodity and cyclical stocks saw clear selling pressure. But when the US session opened, the Nasdaq futures were already up 1.18% before the bell. Stocks opened higher and stayed strong throughout the day, completely decoupling from the weak performance in Asia and Europe. This was a very important signal. Let's dig into a key expectation gap. Normally, a sharp rise in the 10-year Treasury yield would pressure tech stock valuations. But today, the Nasdaq rallied strongly even as yields moved higher, completely ignoring this bearish signal. This tells us that money believes the earnings growth of specific AI-related tech stocks is strong enough to offset the pressure from rising rates. The stock-specific and sector logic is very powerful. Furthermore, the sharp sell-off in A-shares today did not drag down US stocks. Instead, US stocks marched to their own beat. This shows that major US capital has formed an independent narrative based on the AI industrial trend, and has decoupled from the sentiment in the A-share market and the pressure from macro interest rates. Looking at the capital flow themes, the strongest direction right now is undoubtedly AI and tech growth stocks. Capital is consistently betting on the industrial trend and earnings certainty. Another strong area is safe haven assets, with gold and Bitcoin both posting gains. The weakest area is the A-share market and related China ETFs. Weak domestic economic data and pessimistic policy expectations are causing capital to flow out persistently. Looking ahead to tomorrow, the A-share market is expected to open lower or flat and continue to consolidate. It is under dual pressure from domestic sentiment and rising US bond yields, and is unlikely to benefit directly from the strength of US stocks. For the US, the Nasdaq is likely to hold strong above its 5-day moving average, but the Dow may continue to face headwinds. After a sharp sell-off, crude oil has the potential for a technical bounce, but it will need some catalyst from news. Overall, global markets are highly fragmented. The weakness in A-shares and the strength in US tech stocks may continue to widen. For investors, the prudent approach right now is to stay on the sidelines, avoid chasing highs, maintain a bearish view on A shares, and do not try to catch a falling knife. Wait for clearer policy signals before making any decisive moves.